$250,000 in gains inside your whole life policy. Surrender it for retirement, and the IRS taxes every dollar as ordinary income, not capital gains. Most people think surrendering a policy works like selling stock. You owe tax on the profit above your basis at long-term capital gains rates, about 20%. That's wrong, and it's costing pre-retirees six figures they never saw coming. Here's what happens instead. Under IRC Section 72E and IRS Publication 590B, whole life policy gains, especially on contracts that hit modified endowment contract status, are taxed at your marginal rate, up to 37% federal, plus 8% net investment income tax if your MAGI exceeds $200,000 single or $250,000 married filing jointly. On a $250,000 gain, that's $92,500 to $107,500 in federal tax alone, not $50,000, nearly double. Your agent didn't mention this in 2008. They didn't mention it in 2015 either, but the IRS absolutely knows. Why are we talking about this now? Because the first wave of workers born in the 1960s, now ages 55 to 65, are cashing out whole life policies to fund early retirement, and almost none of them budgeted for this tax hit. It's forcing retirements to delay by 1 to 3 years, or spending plans to shrink by 15 to 20%. By the end of this video, you'll know exactly where this tax appears on your IRS return. 3 scenarios showing how surrender timing could save you $30,000 to $60,000, and what to do if you're holding a policy right now. Let's start with the belief gap. Most people assume, I paid premiums with after-tax dollars. My gains are capital gains, I owe 20%. That's the mental model from stock investing, but the tax code treats life insurance contracts fundamentally differently. The IRS separates your basis, what you paid in premiums, from the gain. On surrender, the gain is ordinary income. That's the rule under Section 72E. No capital gains treatment. No preferential rates, just ordinary income at your marginal bracket. Now, modified endowment contract status. If your policy was issued after June 20, 1988, and the cumulative premiums you paid in the first 7 years exceed the IRS 7-pay test limits, your contract is a MEC. Most policies issued in the 2000 for people now 55 to 65 are MECs. And on MEC surrender, gains come out first, before your basis. That means your first $250,000 out is all taxable gain at ordinary rates. Here's the concrete cost. A household earning $150,000 taxable income, married filing jointly, 2024, sits in the 24% bracket. Add a $250,000 policy gain, now you're in the 35% bracket for the final tranche of that gain. That's roughly $87,500 in federal tax. Add state income tax at 5% to 10%, another $12,500 to $25,000. And if your MAGI crosses $250,000, the 8% net investment income tax kicks in, another $9,500. Total, $109,500. Out of a $250,000 gain, you net $140,500. Most retirees planned on $250,000. The shark is real. So what can you actually do? First, pull your policy illustration and confirm MEC status. Contact your insurance company, they have the exact calculation. Second, run 3 surrender scenarios, all at once in year 1, spread over 2 years at $125,000 each. Or surrender, and instead borrow against the policy at a loan rate of 5% to 6%, which may defer the tax event and let you keep the contract inside your estate. Third, coordinate with your CPA on your retirement year tax bracket. Some retirements can be timed to flatten income and reduce the marginal rate on the gain. The form where this hits is Form 1040 Schedule 1, Line 21, Other Income. And the IRS will match it to Form 8949 if your insurance company reports the surrender on 1099R Code 7, Life Insurance Contract Surrender. You'll calculate the gain, claim your basis, and report the difference as ordinary income. If you're 55 to 65 and you bought whole life in the 2000s or early 2010, pull your policy documents this week. Confirm the cash surrender value, your total basis, and whether a surrender would trigger this tax. Run the numbers with a CPA. You could save $30,000 to $60,000 just by timing the decision. The biggest takeaway, whole life gains are not capital gains. They're ordinary income, and that one rule change could add years to your working life or shrink your retirement spending by a fifth. If this changed how you're thinking about that policy, hit subscribe. Next video, we're breaking down the 3 strategies insurance agents use to hide MEC status and the 1 question to ask before you buy whole life ever again. Ring the bell so you catch it. What's your biggest takeaway here? Let me know in the comments below. The tax code rewards those who study it.